staying with us. You're watching Deep Dive with me, Nikunj Dalmia. The next 30 minutes, well, we'll take a deep dive into a scenario. Scenario where what are the sufficient and necessary conditions for India to do well? It's not that we've seen these problems not in the past. 2020 was even worse. 2008 was even worse. Now, when 2020 happened, everybody thought dollar would collapse, but the reverse happened. Money actually moved into the US dollar. Emerging markets collapsed. 2021 happened, well, everyone thought that orientation of the world would change. And what happened? India actually came out the real winner because commodity prices were low, interest rates, they came out. So let's discuss all that. And the first question which we are asking on this edition of Deep Dive with me, Nikunj Dalmia, is that will India emerge as a winner in this entire trade war? I mean, India, US and China are fighting. Is that good for India? Two cats, when they fight, it's a third person who wins. Or it's a fight between two elephants where the grass will also get crushed. So will it two elephants fighting, which will harm the world, or two cats fighting where a third person in this case would win? What are the factors which will drive Indian equity markets? Interest rates, valuations, flows. Low commodity prices, no one is talking about it today. Crude is down, copper is down, aluminum is down. Inflation is also down. How come no one is talking about it today? And then how is this turmoil different from 2008 and 2020? All that and much more with someone who's been talking about the India story for many years now. So Saurabh, first question, will India emerge as a winner in this entire trade war? Like I said, when two elephants, they fight, the grass get crushed. In this case, it is an elephant and a dragon who are fighting. Are we the grass will get crushed? Or two cats, when they fight, it's the monkey which wins?
I think it sounds like the monkey scenario, Nikunj. I think not just India, it's reasonably clear. It's reasonably clear that a bunch of countries are sitting down with sitting down with America at the negotiating table. As you would have heard, Japan, I think, has been first of the block. India is not very far behind. And I think the Europeans will follow. Most of the world, barring China, I think, is sitting down with America. Deals will be cracked in the next 90 days. By and large, those deals will be to the benefit of the Indian economy. As lots of other people have commented, we're not a particularly high tariff economy, nor are we a export dependent economy to the extent that China is. And to the extent that there's an opportunity to be had on China plus one, I think the next 90 days will show the way forward. So the odds are pretty high that barring China, the rest of the world will conclude reasonably constructive deals with America over the next 90 days.
But Saurabh, if Chinese stop exporting to America, it means there is excess capacity in China. Will they dump Chinese products, like we say, made in China, in rest of the world? And could that have an impact on local manufacturing, competitiveness? Because China, in a sense, has advantage of scale, skill, and size. And now it would be desperation which would drive their factories.
And it's not just scale, Nikunj. I think China also has an advantage in that they basically take their citizens' savings and they channel it towards industry at very low cost. So the cost of capital for most Chinese businesses is ridiculously low, some 2-3%. No other country in the world can drop citizens of their rightful savings and channel it towards industry at artificially low rates of capital. And similarly, where need be, the Chinese government takes land from citizens and gives it to industry at incredibly low rates. Again, very difficult for a free market democracy like India to do that. So for many years, this has been the problem. The Chinese Chinese industry, Chinese manufacturing has artificially low rates of low cost of capital and artificially low cost of land, and that gives them an inherent advantage over democracies like America and India. And it's been a bugbear for many years. It's obviously all coming to a head. The whole situation's come to boiling point on this. My reading is China will try to dump on everybody, including India. And the main way for us to deal with that is I think we need to consider depreciating our currency. Beijing is already depreciating the RMB aggressively. I think we'll see more of that from Beijing in the coming months. For them to deal with America, they are already realizing that they'll have to go to the rest of the world. And by depreciating the currency, they're making their exports. Chinese are making their exports even more competitive. And I think we'll also have to consider flooding the system, our banking system with liquidity, The RBI has begun doing that. It's a step in the right directions. We need more interest rate cuts from the RBI, and I think we need the rupee to move towards 100, 105, given the rate at which Beijing will depreciate the RMB.
Okay. But I'll go back to my initial question, which is that if China does not export to US, that means excess capacity in China. Could that have an impact on rest of the world in terms of the local industries, manufacturing, flooding of Chinese imports? Could that scenario happen? If that scenario has to happen, let's think of India. Chemicals, apparel, footwear, जो भी चाइना में नहीं बिक रहा है वो इंडिया में आएगा. I mean that's
we are already agree with you. I'm saying we've already that scenario has already become a real scenario. As you would have seen, Indian steel manufacturers, Indian steel companies have suffered badly over the last 2 years as cheap Chinese steel has made its way to India. And you're right to say in a range of industries, the risk grows even larger of Chinese dumping. My submission was that to deal with this, I don't think qualitative barriers is going to be enough. I don't think tariffs are going to be enough to help Indians deal with Chinese dumping. I think we also need to make our currency cheaper so that in relative terms it becomes more expensive for Indians to buy Chinese products. We need to use currency depreciation to make Chinese imports into India more expensive. I don't think any one tool such as tariffs or qualitative restrictions will work. I think we need a range of tools to be used to make it harder for China to dump in India.
I distinctly remember we had a conversation in 2020 and you said the following, that look, for India to do well, you need three things. Rates have to be down, commodity prices have to be down, and the world should feel a tremor, not an avalanche. I can see the same conditions again. Rates are coming down. Globally, they will come down now. India, they've already come down. Commodity prices are down, and the world is not exactly cracking. There's a tremor because of trade war.
I agree with you. I think we're moving towards that perfect troika. So one of the things I noticed when we made the bull call in March 20, I still remember it was 20th March. In fact, I remember I was on ET Now when the market was
remember,
down
and we called you back. See, my friend, I remember that, and that's why I've called you back. Or you. So 4 years later, how cycles turn, but we remember.
Absolutely. So thank you for calling me back. So what gave us the conviction that day? I still distinctly remember through COVID, we went bought buy. What gave us the conviction was what we had spotted was every single economic recovery in India had come on the back of a US recession, and we had figured out that the reason a US recession is followed by an economic boom in India is an American recession leads to cheaper money. US 10-year bond yield comes down. It leads to cheaper oil. Our country is an oil importing country, so cheaper oil, it's like a gift to us. 2.5% of GDP is gifted to us. And it also leads to the rupee to become cheaper, rupee depreciates, and off we go to the races. We get an economic boom in India. I think we are moving towards that. Nikunj, we're not there yet. We haven't yet seen the Fed cut, and we haven't yet seen oil crack, say, through $50. Oil has thankfully gone below 60. I think oil going below 50, the Fed starting to cut, and the rupee depreciating materially. If that troika of things lines up, if that hat trick comes together, then I think we at Marcellus will start deploying much of the cash that we have accumulated in the last 7 months.
Between March 2020 and April 2020 is valuations.
Yeah. So large caps, we're not that worried about valuations, but small and mid cap valuations are still unusually high. We have worked very hard in our small and mid cap portfolios over the last 7 months to sell the expensive stuff, to go into cash, to bring the portfolio valuations down as much as we can. But I think small and mid caps in India have another 30-40% to go before the valuations can be deemed to be attractive. Large caps are all right, especially the kind of quality large caps that we like are all right. The mid cap piece is still a little too rich for my liking.
Are markets ignoring the fact that tax rate cut has kicked in? If crude goes down, there could be a fuel cut. Interest rates have come down. Inflation clearly not at 6.5 or 7. It is now poised to stay between 4 to 5. All that will lead to consumption demand. I don't see too many people talking about go and buy consumer stocks. Everybody is still saying or if you want to buy banks, or if you want to buy defense, or you buy railways, or if you want to buy beaten down IT. No one's talking about good things which are happening in the consumption space.
So part of the reason, Nikunj, I guess there's a degree of circumspection is the tax cut, the 1 trillion rupees tax cut. I think is useful. All credit to the FM for expediting it. I think on budget day I sat in your TV studio and lauded the FM for the 1 trillion rupees tax cut. But in the context of very high household debt, right? If you exclude mortgages, if you exclude mortgages, Indian household debt as a percentage of our GDP is amongst the highest in the world. In the context of high household debt, in the context of a weak job market, I think the consumption piece is naturally posing a concern. I think the result season that we began a couple of days ago will also see yet another season of weak consumer demand, and that's why there's a degree of circumspection on the consumer stocks. Now, as valuations come off over the next 2 quarters, and I'm pretty sure consumption related company valuations will come off given how weak the demand situation is. I think this piece will start looking more interesting. So the tax cut is a step in the right direction. I'm not sure it's going to be a big driver of consumption in the current fiscal. I think the bigger driver will be rate cuts. I'm hoping to see the RBI push through multiple rate cuts this year. I don't think I think even 200 bips of rate cuts this year, this fiscal year, will be warranted given the underlying ground level realities. And as you're rightly joining the dots, right? If commodities are getting cheaper, demand locally is modest. So inflationary pressures are muted. Commodities are getting cheaper. There is no reason why the RBI cannot expedite hefty rate cuts and flood the financial system with money. And that necessarily will push the rupee lower, but I think that will also be helpful. It'll help exporters and it'll make imports, especially from China, more expensive. So the policy outlook actually is very clear. Lower rates, lots of money in the system, and a cheaper currency. That's what we need. That's what the doctor ordered for the Indian economy. I think that's on its way. And as that comes through and valuations get cheaper, things will look very interesting, I suspect, by August, September.
So post COVID, we all said, okay, time to start looking at PSUs, defense, capex, industrial machinery companies. Is it time now to start looking on the other side? And the reason really could be something which you love to hear, that delay in decision making, capex will slow down. When government did not spend for 6 months, look at what happened to GDP. With this whole tariff interplay, I don't know who will spend where a steel plant will be made, where a car plant would be made, this assembly line will be created, where, and that all just leads to delay in decision making. Capex thanda ho jayega, that's the bottom line.
I think the other reason I would, leaving aside my historical concerns on government and PSU capex, I think the other reason I'd be a little bit more circumspect, even more circumspect on PSU and government capex is I think the tax piece, the tax collections piece, will be fairly subdued in the current fiscal, right? FY26. The capital gains tax piece will, I think, become far more subdued than it has been in the last 3 years. The dividend from the RBI, which has been a hefty amount the last 3 years, will also, I think, be harder to deliver. GST collections, corporate tax collections will also, I think, grow at a more subdued rate than they've done in the last 3-4 years. And therefore, the overall government tax collections piece will be more subdued than has been the case for the last 3-4 years. Naturally, the government will then throttle off on capex. So the 11 trillion, I think the budgeted capex number is 11 trillion for the current fiscal. I doubt we will get close to that 11 trillion. I think if we get to 10 trillion of government capex in the current fiscal, that itself will be a incredible outcome.
See the sequence of events now moving. Equity market in US showed the first signs of a classic trading bottom, lot of volatility and suddenly a spike down and a spike up. That's how markets bottom are made. How do you see the sequence of events moving now? Could it be more crack in the dollar index? Could it be a spike in the US 10-year paper? Could it be revival in gold and silver? What are the patterns which our viewers should look at to understand that by worst is behind us, bottom aane wala hai?
So let me split this. Let me do America and India separately because the economic circumstances of America and India are a little different here. In America's case, in the S&P 500 case, and I'll give the caveat that we are heavily invested in the American market through our global compounders portfolio. In the American markets case, we do believe that the panic and the stress is a little overdone. Talking to friends across Asia, across Europe, it's reasonably clear that the Japanese, the Europeans, and the Indians are moving towards bilateral deals with America. For the Europeans and the Japanese, they get massive defense cover from America. And I find it hard to believe that they will tell America, आप defense cover हटा लो, we will fight a tariff war with you. I think just simply beyond the realms of logic that the Japanese and the Europeans will not go to the negotiating table and sign a deal with America. In our government's case, the government has been very, very clear. The government of India has been very clear for the last 60 days that there will be a bilateral trade agreement. So as the S&P 500, as the world realizes that barring one mega economy, China, barring one mega economy, much of the rest of the world will strike deals with America, trade deals with America. I think there's likely to be a degree of relief in the S&P 500 that will get priced in. And the Chinese piece, I think, is a still troublesome piece. I don't have any easy answers as to how that resolves itself. So in terms of, is the S&P 500 more likely to move up than down? My reading is it's more likely to move up than down. Coming back to our country, I think that troika of things that I was looking for, right? We need lower interest rates. We need more liquidity in the banking system. And we need the currency to be far cheaper than it is today. If we get those three, I think earnings growth in India will come through towards the second half of this year. And if by then valuations are more reasonable, then the Indian market can also rally. At this juncture, at current valuations, it's not clear to me that there is a bull market button to be pressed in India. So unlike March 2020, when we were happy to buy aggressively, we're not buying aggressively at the moment because we can see the domestic weakness. And it's not yet clear to us that the policy piece is as clearly laid out as it perhaps was in March 2020. In March 2020, the government of India did a spectacular job in both fiscal and monetary policy. At the moment in India, the policy piece is not as clearly laid out, and hence we are being more cautious in India.
Really appreciate your time. Thank you for joining us, and thank you for just again, giving us that lovely template. The factors that play or the necessary and the sufficient conditions which can make India shine again. So appreciate your time and thank you very much.
Thank you. Thanks, Nikunj. Thank you for having me.
If you like this video, then like, share and subscribe to ET Now.